All right. Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, excited to be here with you today on the Note Closer Show podcast. And I am really excited with our guest today. Oftentimes, as I reach out to our audience out there, our listeners, our Note Nation peeps out there and ask me, hey, who would you like to see on? What questions can we ask? Because reason we do this show is to help educate you guys out there across the country on different nuggets in the note business and real estate business. And one of the overwhelming questions is like, hey man, can you bring on a CPA to talk about accounting in your real estate business? And I'm like, yes, let's do that. So, and lo and behold, it's funny. I think it's quantum physics. Literally, I get an invite in my inbox. Hey man, are you looking for somebody? And I'm like, yes, we are. So we are honored to have Thomas Castelli joining us from New York today. Thomas is not only an accountant, but also a very active real estate investor, and his firm focuses solely on real estate investing. So we're going to dive into the content today, talk about some of the general things as real estate investors need to look for. Then we're going to do a little bit of a deeper dive specifically on the note business. But hey, man, welcome from New York, buddy.
Hey, thanks for having me on the show today, Scott. Happy to be here. Excited.
Hey, no problem, man. So why don't you take a second and share a little bit about your background, kind of where you got to where you're at today before we start diving in and doing some Q&A.
Yeah. So, to make a long story short, I came out of college. While I was still in college, I knew that, the 9-to-5 grind is not where I wanted to be ultimately in the long term. So I started reading a lot of books, The Richest Man in Babylon, Rich Dad, Poor Dad. That rabbit hole took me pretty deep. By the time I got out of college, right in between the period where I started my first full-time job, I attended some local RIA events, and then found a group that did put on basically a seminar for multifamily syndication. That was back in around 2014, and I just fell in love with that business model and that way of doing things. So I started making some investments as a limited partner with a mentor, someone who eventually become my mentor, before doing a deal 82 units in Jacksonville, Florida as a general partner, where I worked mostly on the acquisition side, identifying the property and then getting it under contract, doing the due diligence, and now we currently have that under management. So that was exciting. Right around as that deal was actually going through, I came across the Real Estate CPA, which is the firm I currently work for now. And I got linked up with Brandon, the founder, and he was telling me all about his firm and what he does. And he's like, I'll give you a 2-week period if you want to work for me, see how it goes. So got the 2-week period. Ultimately came out the other side as a full-time employee. I'm a tax strategist, so my role now is helping real estate investors minimize their tax liability through various tax strategies and proactive planning, and really making sure they have a comprehensive understanding of their tax situation and what they need to do to minimize it. So it's an exciting role. I get to help people save money, A, and B, I get to work with real estate investors, which is really my passion is real estate. So when that all comes down, it's exciting.
It's a bunch of fun working with a bunch of real estate assholes, isn't it?
Yeah, no, it's always interesting. You're always learning something new about real estate investing, and also, business and operating a business. And it's just always something different. And that's what keeps it good.
Yeah. As I always say, every day is different, but it's a lot of the same. And it's you never know. It's just a creative mindset of people that I absolutely love. Find ways to make things happen. It's always good versus so yes, we can make this happen. Let's figure out a way versus saying no, which is often what we see in a lot in the workplace, right, Thomas?
Yeah, no, absolutely. I mean, what we do is we go in and we take someone's full picture of what they have going on and we piece it together in such a way. And sometimes we have to change the picture too. We have to say, well, why don't you start doing this, or why don't you stop doing this, so you can make this work. And that's ultimately what it comes down to. So even though the tax laws and stuff like that are pretty, set in stone, there are ways you can be creative with your facts and circumstances and what you're doing on a day-to-day basis that could impact your tax situation. So there's definitely a creative side to this business for sure.
Definitely. So let's start with things. So if you could wave a magic wand, okay, wave a magic wand with the clients that you guys have helped out and the investors, if you could build your prototype real estate investor that would do the things that you told them to do when they need to do it, and to build the premier, the perfect, I don't, there's no perfect, but you get what I'm saying. What are some of the things that you would recommend to new investors out there to set the foundation so that later on they're in a much better place?
Yeah. So, I mean, I guess the first thing to always say is you have to document everything and stay organized within your business. I mean, that's the biggest thing, especially when it comes to the accounting side. Having clean books and having your numbers up to date and having them correct allows you to do a number of things, allows you to make decisions on what you should do to grow your business, or what you should stop doing that's maybe holding your business back. So, for example, you might find in your portfolio that you have 10 properties and say, I don't know, let's just call it Dayton, Ohio, for example, that are doing really well. And you have another 10 properties in, I don't know, Detroit.
Akron. Let's say Akron, Ohio.
Akron, Ohio, that are underperforming. You might say, you know what, let me stop investing in Akron, Ohio. Let me move my resources to Dayton where they're better performing. You can't do that without knowing the numbers, the income and expenses for these properties. That's A. And then B, you can't make any tax projections. You can't make any tax decisions where you don't have clean books. So I think the first thing the ideal client would have to do is get their accounting system in place and in order, and making sure they're updating it on, at minimum a monthly basis, if not a weekly basis.
Wow. Yeah. And I'd say definitely on a monthly basis, at a minimum, at least that. If you start doing that, you're going to get beyond and forget what things are doing and
exactly
not be able to document as well. But so that's the thing, setting up your book, setting up and talking with individuals to get things rocking and rolling for you, and just putting the systems in place, because it's much easier to do it from the beginning than trying to wait 6 months to go back and do things again. Right.
Oh yeah, 100%. I mean, it's much easier. I mean, I've seen so many people situations that are so far messed up. I'm like, I wish you would have came to us earlier. We would have been able to untangle this web a little bit better. Like I always say, it's like a shoe. If you just tie the shoe correctly the first time and maintain that shoe and make sure you tie, it's not going to get knotted. If it gets all knotted up, it becomes a mess to clean up.
The analogy comes to mind is like Clark Griswold at Christmas light time. If it's nice, it's all wrapped up. Otherwise, it comes out and Rusty's got a ball of light you're trying to undo, right?
Exactly. And no one wants to deal with that. It takes more time. It's frustrating. It's just better to get it done right from the first time and maintain things just right going forward.
Now, how many investors or how many of your clients do you see have done that though? Or what would you say is the percentages of those that have pretty clean books versus that come to you, or those that procrastinate on doing this?
Okay, I would say probably 70% don't do this. 30% do. And it might even be a lower percentage that do. I'm just giving a conservative number based on what I've seen recently. There's some people who are super on top of it. There's some people in there who don't care at all. There's some people in there who know they need to do this and understand they need to do it, but don't have the time or the know-how to get it. And sometimes we could help people with that aspect of it. But, in general, I'd say, more people don't do it than people who do.
And it definitely affects them derogatorily in the long run. Let's be honest about that, right?
Yeah, no, it does, because it becomes very hard. Like my role as a tax strategist to help you make a decision on how to reduce your tax liability. If I don't know what your income is for the year or what it is even currently at this point, let's just call it in June, it's hard to make those determinations when you're for instance, if a client comes to me and says, I'm like, so what's your net income on property A? And the client goes to me, I don't know. Well, it's hard for me to make a recommendation of what you should do because you don't know your income. If you come to me and say, hey, look, yeah, property A is net income is $1,700 for the year or year to date, and property B is this, property C is that, I could project out what your tax liability is going to be and then therefore help you reduce it. If we don't know what those numbers are, we can never get a handle on what your tax liability is in the first place to make any recommendations at all.
Mm-hmm. Yeah, you got to see the big picture, definitely, and be able to see where everything's coming from. That's one of the most important aspects of not only just in real estate, but entrepreneurship, is knowing where your money's coming, and being able to focus. Focus the parental rule. If you got 80% of your income coming from 20% of the type of assets, you should focus more on those 20% type of assets versus the others, right?
Yeah, no, 100%, and that's what having your books up to date, clean, and correct. That's what that allows you to do to make those type of decisions.
Cool. So besides having their books clean, what's another thing that's important to people that you would highly recommend? Have an IRA or having multiple LLCs, or what are some other things?
The next thing is it's just working with a CPA who's going to put together a comprehensive tax plan for you, and who's going to be proactive, because a lot of people out there, they go to their CPA and their CPA says, they go once a year in January or February to get their taxes done, and the CPA might say, okay, contribute a little bit more to your 401k or do these little tasks, but never really gives comprehensive advice. And what I see a lot of clients do is we'll review a client's situation and we'll look at it and we'll say, well, why weren't you doing this last year? Why weren't you taking advantage of 100% bonus depreciation? Why weren't you taking advantage of the real estate professional status? Why weren't you, doing XYZ? Well, my accountant never told me anything about that. Why did, my accountant never mentioned that? I had no idea that I could be doing that. So it would be just really getting yourself set up with a comprehensive tax plan where you're understanding everything that's available to you and what you should be prioritizing too within that to really to minimize that tax liability. So, I mean, that's another big thing. Other than that, it really comes down to the individual situation of the client, and just having an understanding of where you're going as well. You have to understand, what your goals are and what not only your goals are for say 2019 or this year, whatever year it is, but also big picture, so that you can set things up in the right way, just from the beginning, like we kind of alluded to before.
Well, but that's the thing. You start with the end in mind. Yeah. You get somebody that start with the end in mind. You may not be where you're at now. I mean, where you want to be in 5 years or 10 years, but at least have that idea. And you said something very, very valuable. I think I want to make sure it's a nugget that people understand here is working with somebody who's going to help you plan that out, not be reactive and just sign off on your taxes every year, but literally having I won't say a mentor, but somebody who's going to give you very valuable counsel about what you're doing or maybe doing incorrectly. Right.
Yeah. 100%. And let me just to add on to that for a second, one thing that most rental property owners should not do, and is put their properties in an S corporation. And this starts with the end in mind, because in order to get your properties out of S corporation, you need to sell the property. You can't just transfer it out like you could with a partnership or single member LLC. And that becomes really important when it comes to estate planning. And that begins. And if that your goal is to say leave a legacy, or you whatever the case is, when you pass on, it's gonna be a lot easier to structure your business in a way to make that estate planning process easier to transition to when that time comes. Whereas if you don't know what you're doing, or you don't know what you ultimately want, someone could give you advice that might be very sound advice today, but ultimately have a detrimental effect on your tax or financial situation down the line. Whereas if you would have known that's where you were headed in the beginning, that advice might have been different.
That totally makes a lot of sense, because things and priorities change as we get older. Health, family, estate planning, things like that. That's a good bit of advice there. Now I want to come back. You said having the real estate professional, what'd you call it? I'm drawing a blank here.
The status.
The status. That's it. Do you see a lot of people goofing up and not using that? What are some of the advantages of having that status?
Yeah, so the real estate professional status ultimately allows you to take passive losses against your ordinary income. So most real estate, rental real estate specifically, the rental income or loss from that is considered passive, and because that's put in its own little bucket, and passive losses can only offset passive income, and passive income be offset by any type of income. But the bottom line is, usually when you have rental real estate, you have all these losses that are created by depreciation. And these days, with the Tax Cuts and Jobs Act, you can use 100% bonus depreciation and cost segregation studies to really increase that loss amount. But unless you're a real estate professional, those losses are going to be suspended and carried forward to when you have passive income. So in other words, rental income, or you sell a property within your portfolio and you generate a capital gain, then those losses are going to be those losses will be unlocked. But the real estate professional allows you to take those losses and use them against your ordinary income today. And if you're a full-time real estate investor, or say, for instance, your spouse doesn't work, your spouse works part-time, there's a chance where you could qualify as a real estate professional and really do damage in a positive way to your taxable income by reducing it with those losses. So it's really powerful. And there's just sometimes when I've seen full-time investors or someone could easily qualify for this, not taking advantage of it. And, it's really from lack of advice. So that's real estate professional status. Do you want me to go into the requirements to get there? Or
you're reading my brain, brother, because I think that's a valuable nugget for people listening out there and saving on taxes for sure for the most part. Let's talk about that. You're doing a great job, man.
No, thanks. So there's two different parts of the real estate professional status. There's the first part, which is the 750 hour requirement. So you have to work 750 or more hours in a real estate trader business, and more than half of your total working time. So if you had a part-time job, say you're a consultant, and you work 1,000 hours being a consultant, you have to work 1,001 hours to get that first requirement. That qualifies you as a real estate professional. The businesses you can work in to get there are pretty vast. I mean, you could work in as an agent, you could work as a property manager. The key there is you could work as an investor. The key there is you have to own 5% of your employer if you are employed, to count those hours to qualify as a real estate professional. But just getting to those hourly requirements is not enough. And before we get to that, let me just back up and just add in there that if your spouse can qualify as a real estate professional, then you both qualify. Both married couples are considered real estate professionals if you meet that first test. Next is the material participation test. That test says that you're materially participating in your rental portfolio. And that's usually with rental activities, things like screening tenants, signing new leases, advertising for rent, and just general rental activities. That's what usually gets you there. Because you're as a real estate professional, you're going to have probably multiple properties. In order to not have to meet that test on each property, you ultimately group these properties together as one. And there's 7 different tests to get the material participation. The most common one, I would have to say, is the 500-hour test. That 500-hour test, it means you're spending 500 hours across your rental portfolio because you're grouping them together. You're grouping multiple properties together across your portfolio, and that's what allows you to take your losses. If you don't meet the material participation test, you can't use your losses from that activity against your other income from, say, your W-2 job, your spouse's W-2 job, or another active business you might have where you're self-employed, like being a consultant or a doctor or something along those lines.
Cool. So 500 hours, that's an average of 10 hours a week for 50 weeks out of the year if you're doing that on a portfolio of 10 assets, you're saying?
Yeah.
Now, those 10 assets should all be titled the same in the same LLC. You'd be the owner of that LLC, but at least 5% or more, basically, on some of the numbers you've mentioned.
Yeah, so that part of it. So you need to own at least 5% of the entity to take these hours. But the structure of it isn't necessarily as important as, because you could just group all your rental activities together. So I could be 10% owner in a partnership, and I can group that together with a property that I own 100%. Okay. So that part is a little bit more new. Is in general not that important. On a case by case basis, there might be some issues to look into for some clients, but in general, it's just that you have that ownership percentage and that you're actively participating in it or materially participating in it.
Good. Now, how would you classify? Would you classify mortgage investors, people that are buying distressed debt, in that real estate professional, or would you classify them somewhere else?
Yeah, so that's a good question, and it's a gray area for sure. In certain circumstances, you may be able to qualify, but most of the time, you're considered to be in the business of finance. You're not the real definition is real property, trade, or business, and that's usually things like property management, brokering the real estate.
If we took back a lot of REOs and we had a rental portfolio from foreclosures that we took back, would help constitute that.
Correct. So if you're actually then acquiring the property, whether it be through foreclosure or otherwise, that's when you're in the real property trader business. Until then, you're really in the finance business, and for the most part, it won't qualify. Now, that said, you could be a real estate professional and be in the finance business at the same time. which would be lucrative for if you're a note investor.
There you go. Good stuff, man. I'm loving it.
Yeah.
So my ears are tingling. That's a good sign. So those are some great things. Starting the end of the mind, making sure you hire somebody who's gonna be proactive for you. What are some of the biggest things that you see that just drive you ape shit when you're talking with clients?
Liquidating 401k, liquidating retirement accounts early liquidations. So, I mean, this kind of gets into retirement account philosophy and investing. I think at the end of the day, retirement accounts should be for that. When you have a retirement account, you should be using it as a retirement account vehicle. That's what it has been meant for. Now, you can self-direct these accounts and invest in any number of things, whether that be direct property. You can invest in notes, note funds, hard money, private money through the retirement account. And actually, with self-directed IRAs specifically, when you're doing that, that's the ideal investment, not only for the retirement account, but that's the ideal, one of the ideal vehicles to operate the type of business out of, because you're completely sheltering the interest income from tax within the account. There's no UBIT for everybody who's familiar with UBIT out there on the active investments that are leveraged with debt. There's no UBIT, none of that. And that's the ideal vehicle. Now, some people want to say, I'm going to go pull my money out of the retirement account and take, okay, so just paint this picture, right? You're getting a 10% penalty. Just doesn't matter what your tax bracket is. You're getting hit with 10% penalty. You're getting hit with federal taxes, which could be anywhere from 0 to 37%, and state taxes if you're in a state that charges state tax. So you could be, I've seen clients easily pay 35 to 50% of their balance, in taxes, and that's greatly diminishing the principal you have to invest. Whereas even if you are going to invest in direct real estate and you are going to get hit with that UBIT tax, I don't know if you want to go, we could go into UBIT, but UBIT basically is going to diminish your returns, from my experience, anywhere between 1% to 2% maybe on direct real estate. It's and that's on your return. That's not on your principal. Here, you're taking your investment principal and hitting it. You're really doing it doesn't make sense from an investment perspective, and that's probably one of my biggest pet peeves is when I see people doing that. Especially
and we're talking about they're pulling it out permanently. They're not pulling it out temporarily and putting it back in and taking a loan against their 401k or using a quick withdrawal and then putting it back. With 60 days, you have the right to put back without penalty and taxes. Is that correct?
Yeah, for IRAs, you have 60 days. I think it might be similar for 401ks, but 401ks, you can take a loan. Yep. So you can take up a loan of up to $50,000, well, up to 50% of your balance, up to $50,000. So you could take a loan out of 401k. You can't do that with an IRA. But for what I'm talking about liquidating the IRA and getting hit with these penalties to go and do investing in real estate in whatever form you're planning to invest in. There's just better ways to go about it. And I just hate to see that. I hate it.
Tell us how you really feel.
I mean, I just
it's coming out of you, man. I love it. But
you can't stand it.
You risk being, that's the thing is, if it's a retirement account, don't be using it to finance use that if you're using the self-direct and do a transfer in kind. But I've seen this, I'm liquidating. I'm like, why are you liquidating? Leave it to a transfer in kind. It's an easy thing. No penalties to do that. You can still use it. One of the things that I always tell people is, like, no matter how much money you have in your retirement accounts, you got to learn how to market it, because at some point you're probably going to be using other people's money to drive in, to drive deals and take down bigger things. So that's good stuff. Now, is that the only pet peeve you have, or that's the biggest thing for the most part?
I mean, that's the biggest thing I have as of late. It's just, another pet peeve is when people, when you give someone advice, you tell people the roadmap, you give them the roadmap, and they say, then they do a number of things. Either they don't act on it. So in order to do anything in life, right, if you're going to get advice, whether it be from a coach on how to do investing, or you're going to get advice, tax advice, there's going to be something that you're going to have to do to implement that, for the most part, right? You might have to change some facts and circumstances, and people don't like to hear that. Sometimes people just want to do everything they're doing now, and if you keep doing the same thing, you're going to get the same results. So that's another pet peeve. Another thing is when someone comes to you as an advisor and they say, "Well, I've read about that on the internet." Well, I don't need you. Well, when you're coming to an advisor or you're coming to a coach, you're coming from guidance on your personal situation to really understand, to make sure that you're doing what you're doing is right, and that you're coming from someone who's done it before, from a professional who really understands what they're doing, for your peace of mind. I mean, if you're a do-it-yourself person and you can go and read everything you want on the internet, and if you want to piece it together yourself, you can. But if you're going to be working with a coach or an advisor, understand that you're coming to them for guidance and peace of mind, and you're not coming to them necessarily for them just to tell you something you can read online. So I mean, that's just another pet peeve. I don't know. It's something I see.
Well, but I'm glad you say that, because a lot of times people seek advice and they're getting advice from everybody. When I think when they come to speaking with an accountant or an attorney, they're getting counsel, and they're dealing with people that don't want them to fail. You don't want somebody to fail when you give them counsel, give them a roadmap. And that's the most frustrating thing, is when you give somebody a roadmap to success and they choose to take the exit ramp before the first road, or they want to argue with you. And I'm like, why are you wasting my time? You're going to sit here and argue with me? Yes, it's not easy. People have to make changes in their daily, weekly, monthly habits to get somewhere different. But if you're, like you said, if you're doing the same thing and expect different results, you're the crazy person, not the person trying to give you advice, right?
Absolutely.
When you guys are dealing with investors all across the country, not just up in New York, correct?
Oh yeah, no, of course. No, we're dealing with investors nationwide. We have clients in, I think, like 37 states, and some states more than others. We see California. We have a lot of clients in California. We have a lot of clients out of Texas. We have some we have a handful out of New York. We have a lot of Virginia for some reason. But yeah, I mean, we're across the nation, all 50 states.
Now, with the recent updates of the tax code, what are some things that people are missing out there that they should be taking advantage of?
Yeah, so with the new tax code, 100% bonus depreciation is probably the biggest thing in there for real estate investors. It allows you to depreciate your 5, 7, and 15-year property all in the first year you place that property in service. So when you combine that with a cost segregation study, I mean, I'll give you a quick example, right? Say I buy a property for $1 million. Generally, cost segregation could save you anywhere between 20 and 30% of the purchase price. Just depends on location, any number of factors. But let's just say 25%. You're able to take a depreciation deduction of $250,000 that year. Now, think about that if you're a real estate professional. Say you're a real estate professional, and I don't know, let's say your spouse is a doctor who's earning $1 million per year. That's $250,000. That's going to reduce your taxable income right there to $750,000 right off the bat. And if you're at the 37% tax bracket, that's saving you $92,000. And so 100% bonus depreciation from basically 2018 to 2023, and then it starts to go down. But basically, for these first few years, you're going to be able to take massive write-offs, against your income. If you're a real estate professional, great. Even if you're not, these losses will be suspended and ultimately just be used when you sell your property. It will be unlocked. So, that's probably the biggest nugget in there. The other one in there is opportunity zones and funds. There's some exciting things you can do in there. The momentum is not picking up quite as much as you would expect. I think that's largely because of the lack of final guidance by the IRS and Treasury and really how to do this, which is caused primarily by just the rush bill, in addition to the IRS and the government shutdown that took place earlier this year. So those are the two biggest things out of the Tax Cuts and Jobs Act, I would say, for real estate investors.
But that's huge money. I mean, that's huge savings. It's huge being able to write that stuff off. That if you don't know about it, you're literally just throwing money away, right?
Yeah, I mean, it's with real estate, you really can get your tax liability really close to zero, and you could do that largely with 100% bonus depreciation.
Mm-hmm. That's good stuff there. Now, what's an ideal client for you? Let's talk a little bit about people that you guys are working with. What's kind of an ideal client? Somebody that your run-of-the-mill client that you start off working with and build up.
Yes, I mean, I think our ideal client has, just got started in real estate. We can really help them set everything up going forward, and just really get them into a good position on the accounting side, making sure they are setting up their accounting systems right, starting from the beginning, as well as the tax strategy side, making sure they have a tax plan and that they have their entity structuring right from the beginning, because that can easily get really complicated. But also an ideal client might be someone who's already in the thick of it, who's already there, who's already has 10 properties, and now we need to kind of help them readjust and get everything reset up, and just help them get things moving from where they are currently. So I mean, I wouldn't say that the ideal clients may be based on size. Maybe it's based on direction, where you're going. We can help active clients, people who are active in the business, a lot more than we can help people who are passive investors.
Mm-hmm.
And if you're going to be investing in syndications, you're going to be investing as a passive investor, there are ways we could help, but it's just not as great. So I'd say you're actively getting involved, whether you're just getting started or you're already in the middle of things. That's the ideal client: active real estate investors who are building a portfolio. That's
a great point there, because I know a lot of people as real estate entrepreneurs, we're a lot of control freaks. Would you agree to that? From what you're saying?
Absolutely. Absolutely.
And a lot of times we're at the point where like, oh, we'll do it ourselves. I pay somebody to do my books when I can hire a part-time bookkeeper to come and do it. But when you said that number of like 10, really, that's one of the things we see in the note business too, is with documents and things coming in and all the moving parts that go along with it, you start getting into that double-digit asset stuff. There's no way you can keep track of it all yourself. That's why you've got to bring on an accountant like your guys' firm to really help long-term, because there's not enough hours in the day, especially if this is a side hustle for you, or even a full-time hustle, to keep up with everything, to be a tax expert and a rehab expert and a note expert and an entrepreneur in the same thing, right?
Yeah, no, 100%. And we see this all the time, and I'm the same way. I'm that person. I would love to just do everything myself, but I think you have to realize that when you're getting into the real estate game, you're really building a business at the end of the day. And that business, when you have a business, you have different aspects of that business that need to be adhered to, especially as you're scaling. You have to realize what the highest and best use of your time is. And people always talk about this, but as an investor, your highest best use of time is finding deals, finding investors. If you're on the note side, it's identifying, who to lend to, who not to lend to, and securing those notes and whatnot, securing the financing. Maybe you're using HELOCs for those notes. It's not doing the accounting. It's not trying to be the tax strategist yourself and piecing everything together. It's not doing the administrative work. It's not sending out all your emails. It's not replying to every email. It's not answering every phone call. Maybe these are things you need to outsource to people or insource into your company at some point, perhaps as you scale larger, so that you can focus on the core tasks that are really going to grow your business. So this is something we see. It's a mindset shift, going from, say, the employee mindset where you do everything to go into the business side where you're learning to let go and saying, you know what, I'm hiring a competent CPA firm, I'm hiring a competent law firm. I'm going to put those tasks in their court and trust them to get the job done based on what my goals are, what my company's doing.
Love it. You're just speaking the same language. That's one of the big things we see with, especially because we had a lot of people come into the real estate space that start off working a full-time W-2 job, and they move into the note space, and they get so used to trying to do it themselves because they'll do it with 3 or 4. And I'm sitting here like, hey, you need to hire somebody. Hired a VA, hired an assistant to do a lot of that little stuff that's really below your pay grade as an entrepreneur. And that way you are focused on the higher dollar revenue generating, or you're the most productive aspect of every time. Because there's a lot of great ways to bring somebody on, either a part-time assistant or a VA or something like that, and be able to write that cost off for having an employee, correct?
Yeah, of course. No, employee expenses, whether you're 1099 contractor working for you or you have them as W-2 employee, 1099s for the most part optimal from an expense standpoint, but you can you could write those off as it's a wage expense. So it's just it's an expense on your P&L. That's deducted from your gross income and reduces your net income and frees up your time. So.
Mm-hmm. What's you as an active investor, and let's talk about you. What's kind of your bread and butter? What are you getting excited about besides people that are cashing out their retirement accounts? Let's get the hot blooded side and the other side. What are some of the things you mentioned? A 92 unit complex in Jacksonville. What are some of the things that you love doing, Thomas?
Yeah. So yeah, I did 82 units, but so the way it basically happened was, I really like the syndication model. I like the model of being able to go in there and put third-party property management, again, outsourcing something to somebody else, third-party property management to do what they do best: tenant the building, oversee the renovations, do the day-to-day accounting, all that stuff. I really like that model. So that's what we did. We did that. It's currently under management. We're finishing up the value add, and we're going to sell it. Now, because I took this role on as tax strategist, I kind of took a step back from more of the active side of the real estate. It's just because of where we are in the game of syndication in the multifamily position. I'd be competing at this point with people who already have businesses set up, relationships built, and all of this. So I just see where we are at the cycle as the better to focus on this and kind of just. I did make a few passive investments since becoming it, but just kind of sit back, make those investments. People already have those business set up, and then kind of when the time presents itself, when the market's a little bit less competitive, which I'm sure it's going to happen sooner or later, and then jump back into the active side. So right now I'm just sitting tight, kind of watching everything go by, making investments with people who I could trust to be able to operate those properties during a recession or something like that. And that's where I'm at right now. Kind of just, we have this property that we have under management and making sure that goes right so we can sell it. And then when we exit that deal, I'll probably maybe look at going active again for another one. It just depends on where we are ultimately when that happens.
Sure, no, but that makes perfect sense. And you talked about the market. Where do you see the market going? Are you seeing it? Take it you're expecting to see a downturn of some sort in the near future, based on kind of what you just said.
Yeah, so I mean, I think a lot of the people we interview on our podcast say that they think we're closer to the top. I just think we're closer to the top than the bottom, just based on the run. Now, people always say, "Well, you can't expect a downturn just because we're quote unquote due for one," and I don't necessarily agree with that. I'm just saying, but we're on such a long run. At some point, we're at the longest bull run in history.
Yep.
We have a lot of cheap money going on. The multifamily market specifically is very competitive. Other markets, other real estate markets are getting, other asset classes also seeing an increase in competition. So at some point it's going to drop. And when that does happen, if you have a good cash position, or you have investors who have a good cash position, you can really go clean house and buy large properties. I mean, Sam Zell, right? Big real estate investor. He's been liquidating parts of his portfolio since 2015. And I think one of his quotes he had recently in an article not too long ago, maybe in April, his quote was something along the lines, and I'm paraphrasing, was that people in the near future are going to have an opportunity to buy properties at a steep discount. So, I mean, that's kind of what the way I'm looking at it is. That's where I'm looking at. A lot of coaches and stuff will say, hey, look, you go out there and find properties in any market. You absolutely can. It's just, is that the highest and best use of your time at this point to go compete with people who already have businesses that are set up, businesses that are already healthy, relationships that are already established? Or should you maybe be doing something else now, building up your cash reserve? And then when the market turns in your favor, it becomes a buyer's market. Right now, it's definitely a seller's market. Maybe that's when you dive in and you start picking up properties, and then you ride the next wave up.
I couldn't agree with you more on that, because I think we are due for a downturn. And that's one of the best things that I 10 years ago, hey, it was a buyer's market 10 years ago. Everything was on sale no matter what it was. And we've seen, it's been nice to see things rebound and come back. I mean, there's still parts. I mean, so we still see at a 3.5 point default rate across the country. 1 out of 10 Americans is a month behind on their mortgage right now, or worse. Those are signs that people are getting strapped for cash because they can't afford places to live in. I mean, you live in a expensive place. We got friends in San Francisco that can't afford to live there, even with their jobs, and vice versa. And there's a big upheaval things going on. What are some of the things that you would recommend that people are doing to their books, their accounting, and stuff like that, besides saving money or putting money away for that day when rain starts to coming? Yeah. Is there things that they should start planning with their books and with their accounting to help out with that?
I mean, well, I just taking it back to before, making sure that they're all clean, so you could start seeing, okay, well, so you start doing performance metrics, right? So you can start saying, okay, these properties are performing. Really start looking at the market that you're invested in, and saying, where is that market in this point? It's like, is that market getting a little overheated? Are prices starting to get a little bit ridiculous in that market compared to the fundamentals, right? And if that's the case, maybe you should consider selling off some of those assets, converting that into cash, and having that for the next downturn. And that you can get by having those good records and setting up a dashboard, perhaps, where maybe you're taking the P&Ls. I mean, it depends on the accounting system you're using. You could usually download P&Ls in Excel, and you could manipulate those P&Ls to give you those metrics, and you could start comparing it to the market that you're investing in, and the market overall, and making that decision. Because, you know, for instance, the property, the A2 unit in question, the one we have under management, we're getting ridiculous offers for that property. And the reason why we know they're ridiculous offers, not only are we paying attention to the market, but, you know, we also know what our numbers are. You know, our property manager, you know, in this specific case, keeps very good records for us. So we know, okay, based on our NOI, that this property is starting to get a little overheated. You know, the market's starting to get a little overheated for what this property may actually be worth. So we may be interested in selling it because we think that that's where we are.
Yeah. Why wait 2 years to regentrify an asset if somebody's willing to come offer you a price now for what you think you'd get 2 years from now, and not knowing that what's going to happen in 2 years, right? Yeah, I mean, absolutely. Multifamily, I think it's especially on the larger, I mean, you know, 20 plus, 30 plus, 40, 50 plus, you start getting bigger complexes. I think the pricing is just way overpriced right now. I mean, we see a lot of stuff that's the smaller units, you know, where you don't have a full-time property manager, 20 units or less, you know, where you've got stuff in a local area. Okay, great. Those aren't bad. Those are still priced accordingly, usually because the banks just don't want to deal with them. They want to deal with the higher valued assets for the most part. But yeah, it's kind of a crazy time out there. We've been cashing out of some positions. We've been cashing out of some of our notes, stuff like that. Look at some of our reperforming stuff off and go from there. Now, one of the things that happens with us in the note business here is when we buy a non-performing note, you know, say the unpaid balance is 100 and we picked it up for 30 grand. If we reach out to the borrowers and are able to either modify or get that loan reinstated, the IRS wants to tax that transaction at the full payoff value of that, or the full $100,000. You know, we paid $30,000. We haven't received $70,000 in income in the process. We've just worked to do that. What are some ways that you would recommend for people to help offset that kind of that sticker shock, I like to say, with the IRS?
Oh, you see the debt forgiveness, right?
Yes.
So the best thing you could do there, if you're a full-time real estate investor and you could qualify as a real estate professional, would be to buy properties, use 100% bonus depreciation to offset that gain. Because other than that, it's really difficult to do that. The only other way you can maybe do that is if you're doing inside of a retirement account, where there's no tax liability. Which is what makes the retirement account such a lucrative vehicle for a note investor, is because you can do whatever you need to do within that account, and for the most part, you're not going to have to pay any tax bills. You know, other than that, I really think it is the real estate professional and cost segregation combo with 100% bonus depreciation that would be the ideal strategy. There are some other ways you can do. You can invest in shale oil. Shale oil will help you get there with some things. You could do a conservation easement, which is, you know, right now it's something that's a little controversial because there's some things going on. The DOJ is trying. So briefly, land conservation easements allow you to allow you to invest in a syndicate, essentially, where they will put a conservation easement on it, which means no one could ever develop that land again. And you get a charitable deduction for that easement, and it's usually, you know, it's four to 5 times higher than the investment amount you're getting. So that's one way to do it. But again, with interest income and it's ordinary income, right. So you have to. It's very difficult to shelter, because with ordinary, without being a real estate professional, without using these strategies, the only way you can really do it is through actually having ordinary losses. From, say, a normal business. And generally, to have ordinary losses from a normal business, for the most part, you're going to have to actually have losses. So it becomes difficult. So those are the strategies.
Well, one of the things I know that we've done in the past as well too, I love all those things, is actually having a third party give us a valuation of the asset. I know I've had to do that for IRA accounts. I've had to do that for other investors who've come to me being an expert in the industry. Hey, could you give us a true valuation of this asset? And that helps them offset the value of the asset too, and providing that with their tax returns, where the value isn't really $100,000, it's maybe 35 grand because they've gotten $5,000 in and worked their way to that for you. Have you ever had people use that before or heard of that?
Yeah, I mean, we've had people get valuations of stuff and appraisals to discount the price of the property or the book value of the property to say, hey, look, if this asset really isn't worth what it was anymore, it really is only worth, like you said, say $35,000, where you're paying a little small amount of tax, or sometimes you're actually taking a loss on it. So it's that is another strategy for sure.
Cool, awesome, good stuff there. What was I going to say? There was a oh my gosh. I lost the question. I was going to say, I've already asked the question, what your favorite type of your client that you like to work with, a preferred client, somebody getting started, getting rock and rolling there. What would you say, what would you say is the biggest opportunity right now in the real estate area for people to come in? I know you've laid out some things, the cost segregations and the different write-offs and things like that. What would you say is the biggest opportunity that you're seeing out there? I know there's been some talk about the not the Go funds, but the oh my gosh, the opportunity funds. Yeah, are you seeing some of that taking place?
Yeah, I mean, that's a great opportunity, because what you're doing is with the opportunity zones. So opportunity zones are low-income communities across the nation, 8,700 of them, and some of them are actually more gentrified areas. But what they do is it allows you to go in there and you can buy buildings and you can renovate them, and you can easily raise money for them because of the tax benefits of the opportunity fund. So I think from an active investor standpoint, that's a huge opportunity for you to come in there, buy assets at a low price, be able to do substantial value adds to them, and substantially raise the price, and then sell them, and at the same time allowing your investors to get some tax benefits. Also, at the same time, if you're liquidating some of your assets right now, you can roll the capital gains portion of the sale into the fund. You can roll the entire portion if you want, but only the capital gains portion would get the tax benefits, which is the benefits of being able to defer your taxes, and also reduce them up to 15%. So for instance, if you had $100,000 capital gain, if you held the investment in the opportunity fund for 7 years, you can reduce it down to $85,000 of the capital gain will be taxed on. And as you see that number gets bigger, that could scale good for you. But if you hold the investment for 10 years in the opportunity fund, and it doesn't have to be in the same asset for the entire 10 years either, but you hold the investment in the opportunity fund itself for 10 years, you can exempt you get the entire capital gain from that investment be exempt. So say that $100,000 in 10 years is now $270,000. Well, that $170,000 in 10 years that you would have had to pay capital gains tax on is now completely exempt from tax. So,
wow.
I think that's a huge opportunity, and that's on both sides of the equation. Whether you're liquidating assets, any capital assets, could be stocks, bonds, mutual funds, real estate, notes, all that stuff, or you could do as an active investor and really take advantage of the opportunity to buy properties at a steep discount within these markets, renovate them, and really make a killing on that side. So I'd say that's the biggest opportunity today would be to do something like that.
Wow, that mind-boggling. Thomas, what is there a best way for people to reach out to you to spend some more time with you, or is there something that they can go to your website or something like that to learn more about what you guys are doing?
Yeah, absolutely. So if you want to learn more about us and what we do, the realestatecpa.com would be the best resource to kind of browse through what we have going on. We do have a podcast ourselves, the Real Estate CPA podcast, where we kind of talk about things from a tax perspective, so a tax and accounting perspective. So if you want to learn more about tax strategies, you want to hear interviews from other investors on what they do and how they handle accounting and taxes, what tax strategies they use for their circumstances, definitely want to check that out. Other than that, you can contact me by email, thomas.castelli@wholecpallc.com. Again, that's thomas.castelli@wholecpallc.com.
Man, Thomas, you have been a wealth of information. This hour has flown by, brother.
Yeah, it has. It just went by really fast.
Good stuff, man. Well, hey, man, I'd love to have you back on at a later date there if that works all right for you. Yeah.
I would love to come back on, and I would love to have you on our podcast as well if you're open to it.
I'd totally be open for it. But yeah, I'd love to. We can talk about that later on. But once again, everybody out in Note Nation, you heard some great nuggets here. Now, what you choose to do with those nuggets that Thomas provided is totally up to you. As he liked to said, hey, you got some counsel, go do some things with it. Put your books in place. Don't be like one of the 70, 75, or 80%ers out there who aren't doing their books properly, who aren't taking the time to do that. I know a lot of you out there fall in that category. I was once in that category as well, so I understand that aspect. But the thing is, everything's correctable if you just start taking action to make things happen, right, Thomas?
Yeah. You guys start taking action. All the knowledge in the world won't mean anything for you unless you start implementing it into your life. So, got to take action.
Great, thank you. What's the website one more time for people to check out more about you?
TheRealEstateCPA.com.
TheRealEstateCPA.com. Check out the podcast as well there, guys. Go check out, listen to them. Great interviews on it. I've been binging to it recently and loving it. And that's why we've got Thomas on here. So Thomas, once again, thanks for taking time out of your busy day to be with us. We really appreciate it. And we're looking forward to hearing from you in the future as well.
No, thank you again for having me on. And it was an honor to be here.
Thanks, bud. All right, guys, that's going to wrap it up for this episode of the Note Close Show. Go out, make something happen. Check out therealestatecpa.com and Thomas and reach out to them. Like I said, it's never too early to start putting a plan of success together. Go out, make it happen, and we'll see you all at the top, everybody. Bye.
I know.